Hi, John Grace, President of Investors Advantage. The Money Doctor is in. And what we're going to do real quickly, as best we can, is look back from 2000 to 2013. Because the investors are loving what happened in 2013 for the stock market, but not really loving what happened prior to that, particularly from 2000 to 2002 and then again in 2008. Those were the two reversals of fortunes that have happened since 2000 to 2013. And the question becomes, how might we be better prepared in the event there's another one in the foreseeable future? Many of us think it has to be hold and hope. We're going to say not so fast. There might be a better answer, but we're also suggesting that you ask better questions and you might get better answers. So let's go back. From 95 to 99, from my records it appears as though the S&P and the Dow stock markets doubled and the NASDAQ quadrupled. So that might have been where you took $500,000 and it grew to $1 million by January of 2000. And then you woke up by the end of 2002 and you found that your stock market portfolio was down about 33%, took your $1 million to $666,000. Try living off of that, okay? So then we get the account value back to 1.1, assuming we are making no withdrawals and making no contributions. That's the good news for the hold and hope crowd. But then here comes 2007, 2008, down again, this time 38%, and it takes our 1.1 million down to 684,000. Good news is we held on, so now by 12/31/2013, the original $1 million is finally worth $1.4 million. Now let's suppose we talk about diversification. We add diversification. If you're in 500 stocks, the market's going to do exactly what it does, whether it's the index or the mutual funds. Pretty much they mirror the market. Suppose we just add an element of real estate. Let's suppose we add an element of bonds for the same time period, January 1, 2000, with $1 million. Another, that first reset, 2002, but instead of being down 33%, we're only down 17%. Now the account value drops to $833,000 as opposed to $666,000. If we're down about 25%, 30% or so, we're still in the game. We only need 25 or 30% just to get back to even. We're down 30 or 40 or 50 or 60. We may need 50, 60, 100% or more to get back to even. So what we're suggesting is we look to see, certainly from the past, how we might have limited our downside participation because it keeps us in the game and we don't have to swing for the fences to try to get back to even or to actually see the account grow. So now we're at 833,000. That account grows up to about $1.3 million. Here comes 07 and 08, but it's not as severe for you. Instead of being down 38%, your account's only down 32%, taking the account value to $912,000. 1,833,912, we're in the ballpark. And then we finished the year 2013 at about $1,700,000. The point being that we limited that downside participation. We didn't go as low as most people did, so the gains didn't have to be as robust, but we got most of those gains. If we're looking at it from an income standpoint, assuming again we took no withdrawals over the last 13 years, from an account at about $1.4 million, if we set the speed limit at 4% withdrawal rate, we might have an income of approximately $56,000 moving forward. On the other hand, if the account's at $1.7 million with a 4% withdrawal, the income level might be more like $69,000 on a moving forward basis. So now the question becomes, if it happens again, how prepared are you? This may be a good time for you to stress test your portfolio because it's always the bus you can't see, can't name, and won't understand exactly what happened until it hits you when you're crossing the street. This might be a time to do that to protect your assets. It's important. John Grace, President of Investors Advantage, where we help take the mystery out of managing money.